The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. My name is Todd Rosenbluth. I'm the head of ETF and mutual fund research with CFRA, and I'd like to welcome you to today's webinar on cyclical versus defensive investing, the forecast for the second half of 2019. Joining me is my colleague Lindsay Bell, investment strategist at CFRA, and Dave Mazza, who's the head of product and at Direxion. Thanks, everybody, for joining me. Here's a picture of us. We're going to move on here just to the agenda. As I remind you that this session is being recorded, a link to the recording will be made available within the next few business days. And during the session, we are going to take some questions. We'd encourage you to submit them in the GoToWebinar panel, and we'll do our job to get as many of them done as we can. Now, for the agenda here, we're going to cover just a reminder of who CFRA is, recent changes that we've undergone that we're really excited about. Dave and I are going to talk about the ETF landscape, specifically the cyclical versus the defensive side of that landscape. Lindsay's going to give a recap of where we've been so far with earnings and some projections for the second half of the year. Dave and I are going to come back and talk about the ETF choices that are out there for this environment, and then we're going to take some questions. So just now moving on to about who CFRA is. So we are an independent research provider. You're probably aware of that, providing actionable research and analytics on stocks, on ETFs, and mutual funds. We also have commentary on sectors and industries. We do this using our coverage of the underlying stocks, favoring the forensic accounting research and analytics to give independent research for our clients. Now, just depending upon which side of the ledger you're on, we work with institutional clients such as asset managers and hedge funds and mutual funds. We also have a strong presence within the wealth management space, wirehouse broker-dealers, independent broker-dealers, RIAs that clear through online brokerage firms. We're excited for all of you to join us and learn more about the various tools that we have. We're extremely excited about news that just happened in August. You probably saw this, but in case you didn't, CFRA acquired FirstBridge Data. FirstBridge is an ETF data and analytics company that I've been familiar with for a number of years. We think they really complement the work that we're doing here on the ETF side of the firm for a number of reasons. They bring strong holdings level data and reference and classification information that is ETF specific as opposed to mutual fund oriented classifications and holdings that was in ETF data was combined into. They've got stats that are global. The data visualization tools are really exciting. If you've seen some of the thematic research that we've published in the month of August tied to ETFs, we've been leveraging that quite a bit. And so we're extremely excited to have FirstBridge part of the CFRA family and to welcome in the team and have you get to know more about that information, and all of our clients get to do so. And then lastly about us, we are an independent research provider. We don't manage money. We don't make trades. We don't have our own mutual funds. All we do is research, and that allows us to be able to share our investment ideas with you and for you to have confidence that what we think is what we say is what all of our clients have access to that research. Now here on our ETF side and our mutual fund side, we separate those two areas of the universe. We treat ETFs like an ETF, looking at fund-specific characteristics such as the expense ratio, trading costs, and we combine that with our holdings level analytics, which we'll come more in depth on. But if you're familiar with our stock research, you're familiar with the fact that we have strong buys on a number of stocks and strong sells on a number of stocks. We use that to drive our holdings-based equity ETF research. We separately rate fixed income ETFs, more than 260 of them. But we use credit quality, duration, and yield. I won't spend too much time on the lower half of this other than to say we treat mutual funds independently, incorporating the performance record and what's unique about the cost structure of those funds. On this next slide here gives you a little bit more of a visual description of the way that we're different in our mind than Morningstar, more forward-looking, more holdings-based. We incorporate cost into our rating of mutual funds and or ETFs. And we're leveraging a team of 75 equity and accounting analysts to really help us dive in deep about our overall coverage of equity ETFs, fixed income ETFs, and the mutual fund universe. Now, with that behind us, we'll move on here just to talk about the overall ETF landscape. This is where I want to bring Dave back in. Dave, let's move here to the next slide just to show our overall audience over $4 trillion that we've hit in ETF assets, and the flows have really been strong, over $140 billion in 2019. But this year has been different than in the past, correct?
Yeah, I think it's been different in a big way in regards to the differentiation between what we're seeing with equity ETFs and fixed income ETFs. And as shown in your slide here, Todd, if I look on the right-hand side, on the asset side, of course we know U.S. equity ETFs remain the predominant part of the U.S. ETF landscape. However, this year, both I think in a sign of just increasing investor comfort with fixed income ETFs and the uncertainty that exists in the market, we've seen fixed income ETFs dominate from a flow perspective. It's really been choppy on the U.S. equity side. There's been periods and days where we've seen tons of billions of dollars move in, and then the same can be said move out. But fixed income, whether or not it's aggregate exposures or on the credit side, that's where we've seen pretty steady interest.
Yeah, even as yields have come down, investors have really been gravitating towards the diversification that they can get either from a tactical perspective or more strategic from an asset allocation perspective. Let's move to the next slide here because we're talking about sectors in part, and Lindsay's going to talk about sector earnings, about the ETF demand and the research that you do, the research that Direxion has connected to individual products, slices sectors into cyclical and defensive. And it's really been a tale of two quarters, the first quarter versus the second quarter from cyclical versus defensive. Is that right?
Yeah, that's correct. Sector ETFs are one of the oldest parts of the ETF landscape, dating all the way back to 1998. But if we break out the universe based off of whether or not a particular sector is pro-cyclical or a particular sector is more defensive, we actually see something quite interesting. So if we look on the slide here, in Q1, those cyclical sectors, your consumer discretionary, your technologies of the world, saw pretty significant outflows, about $7.1 billion. Certainly outflows from defensive, but much more modest at about $1.6 billion. In Q2, overall flows, were a bit muted in that regard, but cyclicals came back into favor, and the defensives remained out of favor. And now in July, you see a bit of a continuation of that. Of course, in August, we don't have the full data up here. We begin to see the opposite of that, where defensive starts to take over. So we like to take an eye on ETF flows to give us a real-time read of sentiment in the marketplace. And of course, what we're seeing here is really just, I think, a reflection of the market environment that we've been in.
Yeah, and so I think the next slide here is going to give a little bit more depth behind the individual sectors. Well, let's talk about what happened at a sector level at a moment, but I want to just draw people's attention to what is classified as cyclical and what is classified as defensive. Many of these are going to be obvious, so consumer discretionary and technology you mentioned being in the cyclical camp, utilities and consumer staples being in the defensive camp. But when I first looked at this data as to how things were classified, two that jumped out at me. One was energy, which is a defensive, and real estate, which is a cyclical. And I tend to think of real estate because of the dividend yield components to be something more stable and steady. So maybe you can just highlight the audience on that.
And what's interesting is, of course, there's a lot of different ways to view these. But if you actually look at the data, it's counterintuitive to what I would actually historically thought to be the case as well. And we've classified these based off of long-term betas to the market based off of various market environments going back many decades. And what's interesting is if you actually look at the energy sector, while often thought of as more pro-cyclical, and of course there are times where it behaves that way, its beta is much closer to the overall market than an area like technology or even materials, which oftentimes people think of energy and materials in the same light. On the other hand, the real estate sector does offer you that higher than average yield and income just based on the very nature of those particular firms, but it behaves in a much more cyclical fashion, much more like financials do than some of the other traditional defensive sectors like a consumer staples or utilities.
So that's great. So let's just dive a couple of sectors that jump out at you. I highlight technology and utilities, one cyclical, one defensive, seeing demand specifically in the second quarter, and healthcare remaining out of favor. But either of those or anything else you want to focus on from a sector perspective?
Yeah, I would agree with those particular areas. I think tech continues to be of interest based off of just its performance. But the area that really that I highlight is that financial side. So pretty steep outflows in Q1. to the tune of over $5 billion. Energy was right along with it as well, with about $3.6 billion out. And we know those areas of the market have actually suffered. But financials did see a bounce back into Q2 and into Q3, whereas energies did not see that bounce back in Q2. And now if we look of late, really maybe up until this morning, August has been an area where those areas have really suffered, in particular because of the yield curve movements that we've seen, and of course because of what's been happening in the broader oil patch. So those are areas that I think investors should continue to keep an eye on, just to get a sense of, again, where's kind of this push-pull coming in the market. So I would note that those two areas were of particular interest to me.
Yeah, and I would just add, obviously, we put these slides together in advance of what we saw happening in August, but equally as important, in advance of what has happened, the U.S. stock market has been rallying quite sharply today, following the potential of easing of the trade tensions that are out there. Lindsay may be talking about that as to what's ahead for the second half of the year from the earnings picture. But again, just we put these slides together in advance. Hopefully you'll appreciate that. On the next slide here, I just want to highlight, we're talking about sectors, but people are buying stocks and they're buying sector exposure in part for fundamental and valuation characteristics. So I found this interesting when we were pulling this together in terms of, yes, the dividend yield is relatively high for the defensive side of it, but the return on equity, the higher quality aspect, is a bit surprising to me. People tend to think you're paying for the cyclical exposure may not have the stability that's out there. Do you agree?
Yeah, it's again, it might be a bit counterintuitive than how people traditionally think of the cyclical versus defensive spread. But if we actually look at it both on a price to earnings and a price to book basis, we would expect the cyclical sectors, again, which has tech and consumer discretionary in there, to trade at a slightly higher multiple. Of course, defensive do offer, in this case, a higher yield, but it's really that return on equity, that profitability side, that seems to be where one of the largest differences is. And the same could be said if we look at return on assets or other measures of profitability. And in today's market, I think one of the areas that we have seen, why we've seen, cyclicals perform so much better than defensives for the majority of the time period this year has actually been that profitability side. Investors have been willing to pay up for that certainty when it comes from companies who are able to generate more profits from the particular equity or assets they have in their business, whereas on average defensives, aren't necessarily in that camp. So we'll see, of course, what the remainder of August looks like from a market perspective, but this really, I think, will continue to be a key on that investors will have when looking at whether or not they want to be in cyclicals or allocate to defensives.
And I would just add to that briefly in that they're paying, or the perception is they're paying up for it, but the price to earnings multiple is not that much higher.
Correct.
People are also paying up for the safety and the defensive characteristics. Utilities and consumer staple stocks are trading at all-time or certainly highs with a different earnings picture. And with that, I guess I'll set Lindsay up. We'll move to the next slide here about what's ahead and what we've done thus far in earnings season.
Absolutely. Thanks, Todd. We'll dig right in onto the next slide. Here, I always think this is a good place to start, really just looking at what earnings season looks like versus what expectations were going into the quarter. And as you see on the right-hand side of this slide, for the overall S&P 500, you see the consensus estimate at the start of the reporting period, which was about in mid-July before the bank started reporting, was for a decline of 2% year-over-year growth. We're looking at 1.5% positive growth. That's about 350 basis points better than expected, which is at the low end of the range of what you usually see. You usually get 350 to 450 basis points better than the initial expectations. This time might have been a little bit different. We didn't see numbers come down as sharply in the 4 weeks prior to the earnings season, which is what we typically see, and that was because coming into 2019, there was a lot of concern and angst in the market about a potential slowdown coming off of the fourth quarter sell-off. So numbers were cut very sharply at the start of the year, so there was less room for a cut going into the reporting period, but still nonetheless, the beat is still a solid one. We're getting positive growth instead of a decline. 72% of the companies that have reported so far have beat on the earnings line. 56 have beat on the sales line. Both of those are better than the historically expected or the historical averages, but just slightly. Again, we're over 90% of the way through the earnings period at this point. And this chart, you'll notice I lay out each sector expectations versus actual results. And if you look at the right-hand side, these are the sectors that have the widest margins of beat. On the left-hand side, you see the sectors with the lowest margin of beat, and actually the last three coming in worse than expected, with more defensive sectors being on that left-hand side, more cyclical sectors being on the right-hand side. Starting with the bad news, the industrials, an 8.6% decline in earnings is worse than the about flat expectation. That was primarily driven by Boeing. We were actually pretty pleased with what we heard from the industrial companies on their earnings calls, really most of them reiterating, if not raising, their guidance in many cases. Energy, 13.8% decline versus a 17.2% decline, really has to do with a lot with the oil prices environment that they're currently in there. With utilities, 9.1% decline versus minus 7.1%. That's a weather issue there. But looking on the right-hand side, real estate, 50.1% growth. We look at earnings per share just so we can compare it apples to apples with the rest of the sectors, but this is really a sector that trades off of free cash flow, so it's not necessarily appropriate. There was one company, Vornado, that blew EPS expectations out of the water. Again, that just seems to be an anomaly. But most importantly, communication services, really nice beat, almost 13% growth versus just over 2% expected. That was really driven by Facebook and Google. Those two companies reported much better than expected results, helping to push the overall total. They're almost 50%, I think, of this sector, so making a big difference in what that earnings growth rate is. Financials and technology beating, healthcare too, here in the middle, the one defensive sector on the right-hand side of this chart, showing a nice gain of 8.2% versus 2.1%. This is one sector that's really been consistent with earnings beat quarter after quarter. But anyway, this is a good way, I think, to look at the S&P 500 index anyway, because looking at different sectors helps you not only decide which sectors you might want to invest in, but also gives you a little bit of an idea of, that cyclical versus defensive tilt, who's outperforming and who's not. And that ties back into, the ROE that you're seeing on the cyclical page, the slide just before that Todd and Dave went through, and you see on this side, those are the cyclical sectors are seeing the earnings growth. So now I wanted to dig into some specific sectors, not really necessarily going with the ones that are beating big, but just some that had some trends that really caught my eyes. And starting with information technology, because not only is it the largest sector by market cap for the MSCI USA Cyclical Sector Index at 31%. The largest sector within the S&P 500 index at 22% of the market cap, but it's also really the quintessential sector you think of when you think of cyclical sectors. So I really wanted to take a look at what earnings growth looked like and what we heard from these guys throughout the earnings season. On the left-hand side, you see the overall growth rate, earnings growth rate versus expectations for the tech sector overall. Half a percentage point upside versus a 4.4 percentage point decline. The range there is pretty solid, but half a percent doesn't sound too impressive. It's important to understand really where the tech sector came from. This is a sector that prior to the second and first quarter of this year saw 10 quarters in a row of double-digit earnings growth, and 7 of those quarters had greater than 20% earnings growth. So it's a little bit natural to start to see a slowdown after you cycle so many 20% growth numbers. But digging into the sector, you see to the right these 3 different groups of bars, shows you the different industries that make up the tech sector. Semiconductors are usually a sector that comes to mind very quickly when you think about tech. They get a lot of press too, and this is probably the most cyclical industry within this sector, but it only represents 17% of the tech sector overall, the market cap weighting. So while that 21.6% earnings decline sounds pretty bad, there's much more that can be made up from these other two industries that I'll get into that can outweigh that decline, which, by the way, was better than the 26.7% decline expected. I spoke with our tech analysts going into and out of the earnings reporting period for the semiconductor stocks, because they can really be a bellwether, I think, for especially economic activity. They're the beginning of the supply chain cycle. And he really believes that a bottom is being put in the semiconductors, whether it be this quarter or next quarter. But by the time we get to the fourth quarter, he's feeling much more optimistic about it, especially the news today on tariffs will continue to support that optimistic outlook. Obviously have to stay on top of that situation as it evolves. But later this week on Thursday, we're going to hear from Applied Materials and NVIDIA to get a better view and vantage point on the semis, as well as what's going on in the tariff space, and maybe the Huawei situation as well later in this week. So that's something to look forward to. Now, software and services, got to touch on that. That is the largest market cap within tech, 58%. 75% of these companies have beat. These are companies like Microsoft, Visa, MasterCard, PayPal. A lot of these companies, people will complain about the valuations, but they reported solid reports. And this is an area that has been consistent in improving their growth trajectory. Look at 12.4% in the second quarter versus 6% expectations. That's a pretty solid beat rate right there. And again, people are willing to pay up for these companies, even if they are trading at rich multiples. And finally, the hardware and equipment space, you got to talk about that, because that's Apple primarily. Apple represents 65% of the market cap of hardware and equipment. Hardware and equipment represents 25% of the market cap of information technology. So it's really one to watch. Now, a 7.4% decline, better than the expectation, but that's obviously at Apple. You're seeing a slowdown in iPhone sales as that becomes a more mature market, especially here in the U.S. But they're building out their services business. It's a stock that we do like, and we'll continue to keep our eye on it. In summary, at the information technology sector, we're expecting to see a rebound in earnings growth in 2020 to about 13%, which is higher than the 11% expected for the S&P 500 index. And I think as long as growth and cyclical sectors remain in favor, this is going to be one that continues to lead the market. Moving on now to slide 19 here. I'm going to dig into a couple of the consumer sectors after discretionary. I'll get into staples as well, because the consumer really has been the engine of our economy for the last couple of years. They've been very resilient. The consumer discretionary sector is the third best performing sector in the index on a year-to-date basis. What's really been driving the consumer and the strength in the consumer has been low unemployment, wage growth that's above 3% for the past 10 months. Confidence remains strong. These people are spending. You saw this morning, small business confidence came out for July. Small business owners remain very optimistic about the economy. They still can't find enough workers to fill the openings that they have. And one of the details that I found interesting within that report this morning was that 20% of small businesses expect to increase their capital outlays this year too. So they really are feeling optimistic about the outlook, despite all the headlines on trade and the volatility that we've especially seen in the market in the last couple of weeks. Now, the consumer discretionary sector is 15% of the MSCI USA Cyclical Sector Index, and about 30% of the sector still needs to report. We're going to hear from a lot of retailers this week and next week. Macy's kicking it off tomorrow. Today, I think Advance Auto Parts reported. We'll get some big names next week, like Home Depot, which is a big market cap name within the retailing industry within this sector. So far, numbers have already been coming in better than expected, as you see on the left-hand side, a 2.6% decline versus a 3.9% expected decline. Autos have been a really tough space for this sector for many quarters now, but GM came out a very large market cap component, better than expected results. Within consumer durables and apparel, you see a lot of home builders in that industry. You got Hasbro and Mattel too, which are popping today on the trade news because they manufacture a lot of their product in China. But the home builders had a very good quarter. Lennar and D.R. Horton, huge upside surprises. A lot of that having to do with the reduction in mortgage rates that we've seen and expect to continue throughout the course of this year. So that could boost this industry within consumer discretionary. Consumer services, when you think about that sector, 12% earnings growth. Again, that's a really strong number in this type of environment. Restaurants are doing very good. It's been a very good quarter for them. Again, the consumer feeling good. And finally, retailing, already looking like a strong earnings season with 8.7% growth, although that's below the 9.4% expectation. That had to do with Amazon, the largest market cap company within this industry. They fell slightly short of expectations as they continue to invest in their business and expand some of their other businesses. So that was, leading to a slight disappointment there, but hopefully we'll hear more positive news as the next few weeks unfold. Obviously, we're going to listen very carefully to a lot of these retailers to hear what they have to say about tariffs. The good news is the news that came out today means that the consumer is not going to have, or retailers especially, aren't going to have to deal with passing along price increases to the consumer over the holiday selling season. So we're avoiding that mess, but the fears we're just kicking the can down the road, and we'll see how long the consumer is willing to carry the economy. Finally, consumer staples, we got to talk about a defensive sector here. They represent 25% of the MSCI USA Defensive Sector. It's the second largest sector, with healthcare being the largest. But I wanted to look at staples because, this has been a favorite sector for the year. They've got a 2.9% dividend yield, above the 2% dividend yield you see in the S&P 500, well above where, wherever I saw the 10-year last was 165, something like that. So this has been a attractive sector for many investors. But the Q2 earnings season was very interesting because you saw that a lot of these companies talked about their ability to have pricing power and pass on price increases to the consumer, despite this lack of inflation that we're seeing in the economy. This morning, we also got CPI numbers that were pretty much in line with what was expected. But we heard from like a Pepsi and a Coca-Cola, a P&G, that they're passing on price increases to their consumer. And so that's going to help with the margin and obviously then the bottom line. Within the industries here, you see household and personal products showing the best earnings growth. Outside of P&G, you got Colgate, Estee Lauder within there. Food, beverages, and tobacco showing a slight decline. Again, prices are increasing, but they've been depressed for quite a while as inflation has lacked. Costco is one company that stood out to me within the food and staples retailing industry. They reported a 5.5% same-store sales number for the most recent quarter, which is really impressive and speaks to the strength of not only the consumer, but their interest in finding value. They're a company that's increasing their dividend payout on a regular basis, and they're able to woo the millennial shopper. So, again, that's just one stock I wanted to highlight there. But I think as we turn on to the next page, Todd's going to talk about a few other stocks that we like.
Thanks, Lindsay. Great recap of where we've gone and where we're headed from an earnings perspective. You touched on some of these, but I want to just highlight, again, reiterating that we at CFRA, when we look at ETFs, we do so from a holdings perspective. The larger cyclical stocks include many that we at CFRA are positive on from a valuation perspective. Microsoft has been upgraded since the last time we did a webinar. Following earnings season, it is now a buy recommended stock. Apple and Amazon and Facebook and JP Morgan were all buys heading into earnings season, and those got reiterated. Again, we do our 12-month target prices to drive our overall research recommendations. So changes are not frequent, but they can do occur based on fundamental or valuation adjustments. The defensive side, again, a bit more neutral, a few more hold recommendations among the larger stocks, but Chevron and Procter & Gamble, which you touched on earlier, being able to pass along pricing, are a couple of those examples there. So just want to, again, reiterate, this is an ETF-oriented webinar, but our ETF research is driven by our stock coverage, and thus these holdings can give a greater sense of it. So now we're going to talk more specifically about ETFs. I'm going to bring Dave back in as we move to the next slide here. When we're talking about cyclical versus defensive investing, and we'll come to the products that Direxion offers in a moment, but this is using the index data. Since the presidential election of 2016, it's really been a very risk-on cyclical side of the ledger, with a couple of exceptions, right?
Yeah, no, that's exactly true. And I think this chart that you have here really illustrates that point in a pretty material way, just because of the magnitude in return differences that we have seen between the cyclical side and defensive side. Now, it's worth noting, though, that as we during pockets of risk-off, during pockets of drawdown, you tend to see the cyclical sector perform worse than you would defensive. And that's really the whole point. So in generally trending strong up markets, the cyclical sectors on average beat defensive sectors. But during those periods where there is broad-based risk aversion, however, they've been pretty short-lived since the last presidential election, you would see defensives do well. So the real question is, well, what does the future look like? And of course, no one has that crystal ball to see. But even in the last couple of days, whether you look at this over the longer time period, rolling time periods, the beauty is that these they do on average behave like you would expect. So on up days, cyclicals outperform defensives, and on down days, defensives outperform cyclicals.
And so investors have that choice. So even though we're somewhat painting a picture, at least in this chart here, that historically it would have been better to be cyclical over defensive-oriented strategies, there are certainly times, for an investor they can rotate, favoring the more defensive side over cyclicals.
Yeah, no, that is a great point. The picture here is one, well, wow, why would I ever look at the defensive sector unless I just am looking for kind of a higher than average dividend stream? But the real point here is that this is a period of time that has seen one outperform others. But we could take this chart back during other periods, and the blue line would be in place of the orange line. The orange line would be in the blue line, and that's really I think the beauty of why we constructed the ETFs that we did, to actually have both offerings, both something like cyclicals over defensives and defensives over cyclicals.
So let's show the slide for that, and this is where you can educate our audience about the products. We moved here to the relative value investing, how somebody can have both a long cyclical and short defensive, or the inverse of that, and how that's constructed.
Yeah, so we really constructed these ETFs with capital efficiency in mind, and with the idea that investors might want to be able to get more bang for their buck, but still be generally long biased. So they're constructed in a very simple way. So on the right-hand side, we can see with what you would end up with something in regards to the cyclical RWCD, it's 150% exposed to cyclical stocks with minus 50% exposure to defensive stocks. So for that $1, you get $2 of exposure, and that additional long side is funded actually with your short side. The real benefit is relative to a traditional long-only implementation. Now I can get the benefit from not just my long side being correct, but actually between that spread between cyclicals outperforming defensives. So if, of course, an investor would have been able to access this particular tool back in November of 2016, they would have had some significantly strong performance because you would have been seeing cyclicals beat defensives. Now, however, we have particular opinions in the market, just like CFRA does, just like everyone listening in does today. The opinion could be the exact opposite. The opinion could be that actually defensive sectors will outperform cyclical sectors over the next 6 months, 9 months, 12 months, 36 months, what have you. And so we constructed RWDC to be the exact opposite, 150% exposure to defensives, funded with 50% negative exposure to cyclicals.
So I would chime in saying here on this slide that we at CFRA have historically not rated some of Direxion's product lineup, those that are leverage and inverse oriented. Many of listeners may not be allowed to use those because they're blocked from various platforms. We are covering RWCD and RWDC because they are not in that regard. They are not just leverage or inverse products. They are more traditional oriented products, but are doing long and short. Are you hearing that from the audience, the wealth management space as well, that they are able to use these products?
Yeah, no, that's correct. So I think our firm is most predominantly known for offering tools for tactical traders, leverage and inverse products that amplify exposures and are really intended for very short-term use. And they deliver on that value proposition on a daily basis. However, these products build off of the firm's heritage of having the ability to amplify exposures and access the short side, but do so in a much more traditional way. Because just to be clear, they are index-based products. So we're actually, in this case, tracking an index that is 150% long cyclicals and 50% short defensives in the case of RWCD. So again, 200% exposure in aggregate, but net exposure still 100, just like you would find in a traditional ETF.
And they don't reset this, like the way that the leverage and inverse products, where the longer you hold them, the greater the risk you may be taking.
Exactly. So any of the potential negative effects that can come from compounding don't apply here, again, because we don't have net leverage in the particular product, which is exactly the reason why many platforms already have these ETFs available, and we continue to see new ones add them as they meet particular asset, trading volume, and time thresholds.
Thanks for that. We're going to move here to the next slide. We've touched on a number of times during this presentation and used the phrase cyclical and being more growth oriented. I thought it would be interesting just to take a look at what is inside RWCD, which we mentioned and Dave talked about it being 150 long, those cyclical sectors, but use Vanguard Growth ETF, VUG, as the reference point here. So Dave, I'll let you talk about your product, RWCD, in a moment, but what stands out to me is that what is classified as growth is not at the sector level, but the security level at most other index-based ETFs, and so there is typically a relatively high exposure to technology, relatively high exposure to communication services, but financials, for example, is an area that there's little to no exposure. It's less than 5% for VUG, whereas financials is a cyclical sector. Maybe you can just add to that and specifically focus on the blue bars.
Yeah, no, that's a really interesting point. So historically, many people have accessed more cyclical stocks through the growth value spectrum. And if they want to have more cyclicals in their exposure, they either own individual stocks that reflect that or would use a growth ETF or mutual fund. But the way that this is constructed is actually, again, looking at the particular sectors that historically have been cyclical or have been defensive. And so in this particular example, to your point, financials is a classic value sector, has been for some time. But in this particular case, it actually receives a pretty meaningful place in the portfolio because it behaves pro-cyclically. Now, of course, as we've touched on a few times, and Lindsay spoke about on the earnings side, technology in this particular portfolio has a very healthy weight because it's historically the most cyclical sector. It has one of the largest weights from a cap perspective. And when you overweight that particular sector relative to more defensive sectors, you tend to see that a large weight to technology, and in addition, consumer services and industrials, again, very pro-cyclical sectors, tend to see their higher than average weights than you would find even with a well-known growth ETF.
So we'll do the inverse of that on the next slide here about the defensive side of it. I've chosen to use a dividend-oriented ETF. This is iShares Core High Dividend HDV. And again, in some cases, the sector exposure is similar. Energy happens to be a relatively high weight or heavily weighted sector within dividend yielding and high dividend yielding sectors, whereas energy overall in the broader market is now roughly 5%, or a little more than 5% of the broader market, and then 10% if you're doing this within the broader MSCI defensive side of it, whereas you certainly see differences in specifically with healthcare, and maybe we'll come back to healthcare in a moment. Before I let Dave, you just to chime in on this, to reiterate, we are at CFRA are not advocating one choose any of these products. We cover iShares Core High Dividend. We cover Vanguard Growth ETF. Our goal is to provide education so that you can understand what the differences are, and if you are comfortable taking on that exposure difference, whether you agree with cyclical over defensive or the inverse, or you decide that you want to stick with a growth or a dividend side of it. But Dave, healthcare jumps off the charts here.
Yeah, no, and that's a great point, Todd. We really developed these as additional tools that we thought were missing in the marketplace to allow investors to construct portfolios to meet particular objectives that they want. In the case of RWDC, when you focus on overweighting defensive sectors, and in this particular case, not shown here, but you are actually underweight, areas like technology and consumer discretionary and consumer services in a material way, you tend to see an extremely large overweight to healthcare. Now, some people could say, well, that 70%, that of course could be too much in one area, but that's really the point of this particular portfolio. The point of the portfolio is that you want to be overweight the most defensive areas in the market: healthcare, consumer staples, energy, and utilities. So we're not particularly trying to move or optimize the exposures based off of a particular model. It's just simply in this particular time, how is the portfolio weighted based off of the cap weights for each particular sector, and healthcare receives that most weight. And again, like I said, in days where we've seen markets rally, this particular portfolio has underperformed its cyclical cousin, but on days that the broader market has sold off, you actually tend to see this have really, really robust outperformance because it's so defensive in nature.
Thanks, Dave. So we'll move here to the next slide just to recap, and then we'll be winding down here. On the right-hand side is a sample of our ETF or the research report that's there that has a depiction of our overall ratings, the drivers of that rating. When you'll see these, if you haven't seen an individual report, please let us know, and we can make sure to get you access to it for any of the ETFs, the 1,500 plus ETFs that we cover. On the other side of the page is more the thematic commentary. Lindsay and I publish a handful of times throughout a given week, combined about investment themes. This is the way that we publish, as opposed to research notes where you would find from our stock analytical team. This page, what we're showing here is the write-up that we did of one of the takeaways from the new data that we acquired as part of First Bridge. And this is content that's available on the Market Scope Advisor platform. On the next slide here, if you are not receiving a weekly newsletter from us, you should. It's free. We want you to be able to know what it is we're publishing. Instead of you coming to our platform and trying to find it, we'll pull out some of the more popular articles within a given week from a thematic perspective from Sam Stovall, who's not in the room, our chief investment strategist, Lindsay, and myself, as well as our stock research team overall. And so with that, we've appreciated that we've gotten some questions that have been submitted already. If you haven't done so and you have questions for us, please do so, and we'll get to as many questions as we can. Lindsay, the first question that came in that I want to highlight for you, Dave showed earlier about healthcare and how significant that is, and I think you talked about how they're doing versus expectations, but maybe we can expand a bit on what's been driving that in second quarter numbers.
Yeah, no, second quarter earnings growth has been very solid for the healthcare sector, up 8.2%, like I showed on my earlier slide. One of the better performing sectors within the index. Again, this is a sector that consistently beats earnings expectations and sales expectations every single quarter. It doesn't really get the credit that it deserves for being as consistent as it is. But I think that Dave's product at RWDC, the defensive index versus the defensive index that has an extensive weighting to healthcare. There's a good reason for that. I went back and looked at last year, the second half of last year, where the S&P 500 declined 8% from July 1 to the end of the year. Healthcare was one of only two sectors that were actually positive in that period. It was up 3.3% in the second half of 2018. Utilities was the other sector, up 1.2%, and you can see both of those sectors within that RWDC product. So this is it really is a truly defensive sector, even if it doesn't have as high as a yield as, say, a REIT or consumer staples or utilities sector. So that it really works well in periods of uncertainty or market turmoil.
Well, thanks for that, Lindsay. We were asked, actually, one of the questions that came in as to some of the stocks that we like within the healthcare space, and on the slide, I believe that we happen to highlight Pfizer, which is a hold recommended stock. We highlighted Pfizer as a hold recommended stock because of its size. It was the fifth largest position, but there are many other stocks within the healthcare space that we are positive on. Merck, for example, another defensive stock is a buy recommended stock. There's a number of stocks within that space, and healthcare is a sector that we're favoring overall from a top-down perspective.
That's right, Todd. We have an overweight ranking on the healthcare sector. It's been a little bit of a tougher sector to own in the first half of this year, again, as many investors flock to cyclical sectors. Also, the overhang of the election and the debates in the discussion about future healthcare and what that will look like in this country has also weighed on the sector. And that is typical going into an election cycle.
And I would just add, I'm sorry, as I was pulling up some additional names. So we have a buy recommendation on Medtronic, a buy recommendation on Abbott Labs, a buy recommendation on Boston Scientific, a buy recommendation on Stryker. There's a whole host of stocks. We just didn't list them on the screen there, but thanks for those, the person that submitted the question asking why, and for us to expand a bit on that. Dave, we're obviously talking about what's going on from a trade perspective that's top of mind for investors. There was a question about within the lineup, is there a way to play that emerging markets, for example, over developed? I believe that's the case.
Yeah, that's one of the other strategy pairs that we launched when we introduced this family back in January. So actually we have an ETF that can overweight emerging markets relative to developed markets, or conversely overweight developed markets relative to emerging markets. So this is RW ED and RWDE in the particular family. And the idea here is we actually take, again, MSCI emerging markets, 150% exposure to that, and 50% underweight MSCI EFA, and then the opposite in the developed over emerging. So this is just one of the examples of the particular pairs that we introduced, again, back in January.
Thanks, Dave. And then I got a question that I'll take for myself here. These are products. I'll tee this up for tied to Dave, but these are products that launched in 2019. I believe they launched in January.
Yes.
The RW suite of products, the relative weight suite of products, and how are we at CFRA covering that? So just a reminder, we didn't have a slide on this, but we at CFRA begin covering an ETF typically within the first 3 months of its history. There's a couple of hundred ETFs that we are rating today that are less than 3 years old that are not rated by other independent research companies. We're able to do that because we're covering the underlying stocks that we touched on. The expense ratio and the bid-ask spread are relatively easy data points to be able to gather, and we're not reliant on a 3-year track record, and as such, we can begin covering ETFs that we find interesting and worth telling the story about today, and weeks and months after they began launching and began trading, as opposed to waiting for a magic anniversary that took place. I'm going to take the time now we'll move just to the next slide here to tell you all about the next webinar that we're doing. We're going to be covering the fixed income ETF universe and asking the question, are bonds different, as we focus on actively managed fixed income ETFs. We've had a number of active versus passive discussions here with you and our broader client base, but we're excited to be doing this upcoming webinar and having guests from PIMCO. You can see on the bottom of the screen here the link from registration. If you go to CFRA's website, you will see under webinars that's there a link to the registration will be sent as a thank you for attending this webinar and as part of the invitation. And we'd encourage you to tune back in again. We're going to be bouncing between different topics in the ETF landscape, and it's exciting to have good friends within the ETF industry. With that, I want to thank Dave. I want to thank Lindsay for joining me on this, and really excited that you've joined us for part of this. Thank you, everybody in the audience, for your questions. And until next time in September, have a great day.